Specifically, about 2 weeks ago, Polaris made 3 incredibly positive announcements on the same day. First, CEO Scott Wine gave us some insight into how the business was doing. He talks about, quote, the unexpectedly sharp recovery we are seeing, which in many cases has meant unprecedented demand for our brands and vehicles, end quote. Unprecedented demand? I mean, he goes on, quote, the influx of new customers to our dealerships is very encouraging as people seeking fun family activities while social distancing recognize that our vehicles and think outside tagline resonate with their desires. Makes sense. Second, Polaris confirmed that they'll be maintaining their standard dividend, which currently yields 2.6%. When the company reported at the end of April, they said that they would delay the decision on whether or not to suspend the dividend until late May. They didn't want to cut the legs out from under their investors unless they had no other choice. Turns out the payout is safe. Third, Polaris doesn't have the cleanest balance sheet, but they negotiated with their creditors to get some relief from the most restrictive aspect of their covenants. Basically, they'll be allowed to borrow a lot more money if they need to through March of next year. Put it all together, and you got an incredibly bullish business update. A confirmation that the dividend is staying put and a lot more financial flexibility. The very next day, CEO Scott Wine comes on our network and gives a fabulous interview to my friend Brian Sullivan on Worldwide Exchange, which is frankly where I got the idea to do this piece. Thank you, Brian. Wine made it very clear that even though the economy is still in rough shape, Polaris is thriving here because they're taking market share in a world where people are afraid to fly or take cruises or gather in large groups. Camping, riding around in an ATV or a snowmobile while wearing a helmet, this is all stuff you can do for fun while minimizing your potential COVID exposure. It's the right sports for the moment. Still, it's not exactly an undiscovered story. Polaris' stock has soared from its lows. The analysts are starting to upgrade it aggressively based on the great outdoors thesis. So then why do I feel so comfortable chasing it here? And you know I hate to chase. Well, because Polaris is taking share. They're bringing in lots of new customers, and I think this is a once-in-a-generation opportunity for this company. Just as importantly, the stock has a reasonable valuation. It sells for 17 times next year's earnings estimates. Hey, compare that to the RV plays like Winnebago and Thor, which sell for 20 and 22 times earnings, respectively, and are more expensive in, again, a recession. All right, so Polaris isn't quite a bargain, but it definitely isn't too hot to handle, especially with that 2.6% yield cushion. Don't get me wrong, Polaris is a somewhat high-risk story. They make some of the world's most expensive toys, and if the economy starts backsliding, well, that could hurt them. We know the trade war with China did some real damage, and trade tensions are flaring up again. If things escalate, Polaris, well, it takes a hit. But the bottom line, if you believe, as I do, that America is reopening rapidly, but we're not exactly going back to normal, too much social distancing, then Polaris is indeed the kind of stock you should own. This is a company that benefits enormously from the V-shaped recovery thesis, and it also works with a slower recovery because the great outdoors is taking market share from every other form of recreation that involves crowded indoor spaces.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.